So I think for me, when I saw that your system could save my family over $100,000 using the exact same budget that we're already used to, I was like, okay, the stock market's dropping. I don't want to put any money there. I want more flexibility and more freedom. So your system saved me money on the same budget. And I told my wife, like, we have to move forward with these
Yeah.
guys. It's just so exciting. So is that the same kind of reaction that you see from the people I'm sending your way, and that you're meeting, is that they're just kind of caught off guard by how much
Yeah.
money it saves them?
Yeah, we typically experience two type of epiphanies or two stages of epiphanies. One on the front end, when they have a consultation with us and we go over it simply. And when I say simply, this is third grade math. We're not utilizing calculus and algebra here. This is third grade math. So during our consultation, we really break it down to everyone's specific numbers, right? So, and it's very easy to understand of how their current budget, and I'll get into the three qualifiers of this here in a second, but how on their current budget, their dollars could be better utilized in a different program than what they're used to and traditionalized and institutionalized into thinking that they should be using, which is the mortgage, the modern day mortgage. And I use the word modern day mortgage because the way a mortgage works today is not the way it used to work prior to 1930s, and especially prior to 1913. Okay, and I can get into that here in a little bit too. It's just a very inefficient, archaic tool of financing real estate. So they have the epiphany of when they first talk to us, they're like, okay, this makes sense. I totally get this now. So they have that when they jump on board. Then about 6 months after they're a client, they have a second epiphany. It's like, holy crap, this does work. Actually, it's working better than what you told me it would. So we tend to be super conservative on the front end so that we're not having inflated expectations. And so 6 months down the road, they're looking at the balance of their home and saying, wow, this is working as projected, if not better. And it's almost like, seeing is believing. They need that second wave of affirmation. So yeah, almost everyone comes to us with two types of epiphanies.
Yeah, I've been obviously I don't ever talk about things on my channel that I haven't researched or that I don't personally believe in. And in this case, I researched it and I believed in it, and I'm practicing what I preach. And that's why I've been like telling my community about this so much. And I know how busy you are. So I appreciate you getting on this meeting and going through this. But as I started, for lack of a better word, trying to explain this in very simple terms to my brothers-in-law and my neighbors, as I'm sharing this, I could see that light go on, and they're like,
Yeah.
oh, wait a minute. Okay, that is different. It's just a different way of flowing my money, but it's the same amount of money. And I've
Right.
asked every one of them, what's the number one reason you don't put more money on your mortgage? And they're like, I'm scared. I don't know if I should. What if I have an emergency? And I say, the number one reason you don't is because it's immediately locked up. But what if it was immediately available and it drove down your balance and saved you interest? And that's when that light goes on. And that's just so like rewarding to see in somebody's eyes.
Yeah, I think this is a perfect segue to talk about the history of mortgages in this country. And I say this country specifically because it's the way that we finance real estate is entirely different in other countries. But it changed in this country, and it changed in 1913. You and I know the reason why what happened in 1913. A lot of people would say depression and things of that nature. Depression was actually in the 20s or World War One. 1913 was the institution of the Federal Reserve. The Federal Reserve gives banks, federally chartered banks, a very specific rule set and backstop, and it's called fractional reserve lending. So for every dollar you put in a bank account, the bank has $10 to lend out. So when you deposit money into a bank account, that is not an asset to the bank yet. They have to get rid of that money. They got to lend it out. It's called arbitrage. So what are they paying you for deposits? Right now, the national average is 0.24%. That's actually up from 5 years ago. 5 years ago, it was 0.17%. So it's up 0 to 0.24%. It's such a low number. Let's just call it zero because it's incredibly low. So fractional reserve lending means for every dollar you put in the bank account, they got 10. You put 10, they got 100. You put 100, they got 1,000. You put 100,000, they have 1 million, right? That's a very powerful magic trick for banks So after the Federal Reserve was instituted, the banks got together and said, all right, let's look at how we can grow core deposits. Now, keep in mind, you're talking to a guy that still sits on the board of a bank. 5 years ago, I sat on the board of a different bank, and the conversations are the same from that bank to this bank. How do we grow core deposits, right? Meaning, how do we segregate Americans' income, get them to deposit money into the checking and savings accounts so that we can lend money out utilizing arbitrage. What I mean by arbitrage, you walk into the front door of a bank, you look to the right, it says deposit here, we'll pay you 0.24%. You look to the left and they got the loan officer over there and says, get a mortgage for 5.5%. We're like, okay, I'm giving you money. You're going to walk over and give it to him, and he's going to lend it back to me at 5.5%. That's called arbitrage, right? And the difference between the 0.24 to the 5.5% is called margin or turn. That's how banks make a profit. And that profit is not 5.25%. That's the margin, right? So the difference between 0.24 to 5.5 is 5.25%. That's the margin, but that's not the rate of return. The rate of return is in the thousands of a percent. That's why banks will always be profitable. Doesn't matter if we have nuclear holocaust, banks will still make money. It's the oldest form of making money. So they looked at, in 1930s, the banks got together and looked at how Americans were depositing their money. And a mortgage prior to 1913 looked very similar to a home equity line of credit, meaning money could move in and out freely 24/7, especially popular with farmers. So let's say you were a farmer and you had a $200,000 farm. All right, adjusting for inflation, that's a really nice farm in 1913. But easy numbers. Let's just say $200,000 farm, right? And you owe $100,000 on that farm, and you need some farm equipment. You need a combine, you need a tractor, and things of that nature. So you go to the bank and say, "Look, you hold the deed. It's $100,000. The value of it is $200,000. I need 10 grand to buy this equipment." No problem. They adjust it right there the same day. Here's your 10 grand. We adjusted the deed entitled to the property. You go sell your crops, come back, he sells 20,000 worth of crops. He pays off the 10,000 and put the other 10,000 towards the mortgage of the farm. He owes 90, or she owns 90, right? That's how a mortgage worked prior to 1913. 1930s, the banks get together and says, we need to segregate Americans' money. We need to separate their cash from them. How do we do that? So they looked at how we were depositing money into our mortgages to pay it off. And again, you go back and ask your grandfather, great grandfathers, what did we do? Oh, back in my day, we paid our homes off in 5 or 10 years. Multiple reasons. They were a better generation. They didn't have the technology that we do today, so they weren't as easily distracted. They were out working and getting after and reading, right? That was their form of entertainment. So they were better educated. But two, they actually had a better system in place as well, one that wasn't yet corrupted, one that is still in place in South Africa and Australia and Brazil and some of these other countries that still do what I'm talking about today, right? And they come over here like, what in the world? Why are you guys doing mortgages like this? This is how we do it back home. Like, for instance, in Australia, the average Australian has 2 homes, and they pay those 2 homes off in 14 years on average. So Australia has the highest rate of second home ownership. Why? Because they can not only pay 1 home off, they can pay 2 homes off in 14 years, where the average American doesn't even pay off 1 home in 30 years, because we're always refinancing, chasing the lower rate in the amortization schedule.
Yeah, I was going to say, in 14 years, you've refinanced 3 times, and you look at the numbers and realize you've made almost no progress.
You've lowered your payment and your interest rate, but you didn't lower the balance because you started the timetable all over again. So the banks got together and said, we need to make a mortgage a closed-in product, because if it's closed in, money can go in freely, but it's trapped and it can't come out freely. The only 2 ways you can get your money or access to your equity is to sell or refinance. We all know that refinances on mortgages are very costly, especially compared to a HELOC. Most HELOCs are free. They don't cost any money. Also, no mortgage insurance, up to 90 and 100% financing. So if they make it a closed-in product, you as an American, are you going to put 100% of your income now towards the mortgage? No, because it's not readily available to you. So now you have to budget, and you have to come up with a payment strategy as opposed to a cash flow strategy. So only some of your income can go towards your mortgage. Maybe you pay extra. Less than 1% of Americans actually pay extra on their mortgage. So it's funny when we talk to people like, hey, I could do something similar. It's not quite as efficient, but I could pay extra on my mortgage and get pretty close to this. And if you run the math, Why do something that's close but not as good? One. And two, why would you do something that traps your money, as you said earlier, and now you're not liquid? So if something does happen, and again, we're heading into a recession, if we're not already in one, inflation, things of that nature, we need to be heavily capitalized. So that's that. The third thing is, have you ever done that? Have you ever paid extra on your mortgage? Well, no, but I'm going to. Again, less than 1% of Americans actually pay extra on their mortgage. And by making a mortgage a closed-end product, you're only going to put some money towards your mortgage and you're going to leave the other funds behind. Well, where are you leaving it? You're leaving it in an operating account called a checking and savings accounts. That's where the banks grow core deposits. So the mortgage, the modern day mortgage, was created not to exacerbate the interest that you pay. That was actually the cherry on top. What it was designed to do was to separate you from your cash so that you would put the rest of your cash in a checking and savings account. So what we're doing with the home equity line of credit is we're actually going back to basics. I'm not going to teach you anything new that Americans in that generation didn't already know. We're just going to relearn it. We're going to get back to basics. So a HELOC being an open-end tool, it not only becomes your real estate loan, but it also becomes your bank account. So it's a vessel to store cash. So as you say, not only are you knocking down the interest that you're paying, but you stay liquid for emergencies or opportunities.
Yeah, I'm gonna share a story that I don't think I've ever shared with YouTube. I don't talk about it with my friends, but you lived through the Great Recession. It was a butt kicker.
Yeah.
I mean, it attacked my in-laws' business. It made me lose a job. I couldn't find a job as a, college educated, intelligent person, and I was cash poor and house rich.
Mm-hmm.
And those are not a good combination, right? And so ultimately, back in maybe 2009, my wife and I were forced to get a lawyer and negotiate with Wells Fargo to short sell our house. Now we didn't foreclose; it didn't damage our credit as much, but I literally burned through all of our savings during a difficult economic time. But I had all this equity in my house.
Mm-hmm.
But because I had no job, they said, we're not letting you touch your own money. You've got
Yes.
to either sell or you've got to refinance. Well, you won't let me refinance. Well, then you have to sell, right? And we had about $100,000 in equity in my late 20s. And
Mm-hmm.
we ended up having to lose that house because I couldn't access it. And I went back and I did the math. And Michael, my payment was like $1,000 and I had
Mm-hmm.
100,000 in I had 100 payments.
Yeah.
I could have literally borrowed the money out, put it right back in. It would have counted as a payment, and I would have kept that house. And yet I had to go through all the shame and
Mm-hmm.
embarrassment of, lawyer fees, of short selling that house because I was cash poor, but I was house rich, but I couldn't
Right.
access any of it. So when this idea came along, and I saw how much freedom and flexibility there was in this tool, I was like, babe, we've got to do this. It makes so
Mm-hmm.
much sense. I will never go through that again.
Yes, and you kind of bring up a valid point of, something else that happened in 2007 and 2008, and being so heavily involved in the banking industry, we attract a lot of hedge funds. Hedge funds are in the business of buying up paper on the secondary market and turning it, right? No different than arbitrage the way the banks do, but the banks have a certain balance sheet that gets inflated and they need to make room on their balance sheet. So they'll say, okay, well, we're going to take this paper, set it off on the side, and we're going to sell it off to a hedge fund. Hedge fund then hires usually a servicing company to service that paper, but they own the asset, and then maybe later they turn around and sell it for a profit. So now that we have a pretty tight relationship with a lot of different hedge funds, they've shared data with us of something that prior to 2015 we didn't know about the 2008 mortgage meltdown. Is that first lien position HELOCs had a default rate 115 times lower than those on a mortgage. So now hedge funds, what they're doing is they're buying up in bulk as much first lien position HELOC paper as possible. Why? Because they want to hedge any losses that they will incur on the mortgage side. So people think, well, I've got a mortgage, I got a low rate. It makes them feel warm and cozy. Why does that make you feel warm and cozy? Because someone told you that's how you should feel. The logic doesn't tell you you should feel warm and cozy with your low interest rate mortgage. That's just great marketing. The reason why folks with a first lien position HELOC had a much lower default rate In fact, one company had 0 defaults. Even to this day, they don't have any defaults. Is the HELOC is flexible. It can cannibalize itself. So just like you said, your interest only payment is $1,000. Well, you had $100,000 of equity, so you've got 100 months that you could have weathered the storm. Well, it's not going to take you 9 years to weather the storm. You know, you've obviously grown a massive YouTube channel. You're successful. You're a go-getter. You're not going to sit on the couch for 9 years. So, but if you wanted to, you absolutely could. It actually goes further than that. We actually know some banks that if you have access on your equity line and you don't make any payment, including the interest only payment, they will make it on your behalf. You're not late or in default. So it can cannibalize itself. And it's funny because I even get into the reverse mortgage market, right? Where we're extorting our best generation, which is our senior citizens, and they're going out and getting reverse mortgages. And there are certain circumstances I would recommend a reverse mortgage, but there are a lot of circumstances I don't, because there's one component. A reverse mortgage is extremely expensive. It is the most expensive mortgage product out there. Follow the commissions, follow the money, right? Follow what hedge funds do, follow what banks do, look into these things, be somebody that's a sponge and just ask the question. Be that 5-year-old and ask why. Okay, give me that. Okay, well, why is that? I mean, my 5-year-old, he's the best at extorting information out of me, because all he's got to do is just say, why? We should be that way. We should be that 5-year-old. So on a reverse mortgage, if I were to originate a reverse mortgage, a $200,000 reverse mortgage, it could pay upwards of $30,000 in commissions to me. Commissions come from profits. Profits come from consumers overspending. But what is the one component that makes a reverse mortgage work? It has a HELOC embedded in it. That's the only reason a reverse mortgage works. Without a home equity line of credit, it wouldn't work. Well, okay, well, if we know that the HELOC is the tool that makes the reverse mortgage work, what's stopping me from getting my own HELOC for free without all these other fees and just program it to work just like a reverse mortgage? The answer is nothing. Absolutely nothing. You don't have to pay a single dime for it, and you could have set up your own reverse mortgage. So it's funny that the government will endorse a HELOC product in the form of reverse mortgage, because you got to make something profitable so that it spreads. Some people may ask the question, why haven't I heard about this? Why is my banker telling me this? It's because it's not profitable. This doesn't make people money, unfortunately. The hedge funds will buy the paper to offset their losses on the mortgage side, but other than that, HELOC paper just does not make money, because there's not, you look at the bankers, when you talk to a banker about this, or a loan officer, call up your mortgage loan officer and say, hey, can you offer me a home equity line of credit? The answer is either going to be no or yes, but I don't want to. And the answer why they don't want to is because it doesn't pay out commissions. And again, where do commissions come from? It comes from profits. Where profits come from? From consumers overspending. So if that's the logic, then I just want to follow that path, and let me just get up my own HELOC. So I minimize the profits to the bank, but I also minimize the interest that I pay to the bank.
Yeah, so I showed this to my brother-in-law who does mortgages, and he was like, I don't know, something doesn't seem right about this, right? I knew what it was. Anyway, I came back to him like 2 months later when he had left the industry. I showed it to him again for his own mortgage, and he goes, this is actually really, really smart. Why didn't I see that before? And I said, because you were making a commission.
Right.
You couldn't see past giving that business away because you wanted to make that commission. But now that your commission's out of the way, you could see clearly, and you were like, oh, wait a minute, this really, really benefits me and my house.
Mm-hmm. Yep. Yeah. Unfortunately, greed gets in a way. And I'm not saying that the brother-in-law's immoral individual. He's got to put food on the table.
He did nothing wrong. He just couldn't see clearly, right?
I was the same way. I was a 17-year mortgage vet. I did not want this to be true because of my greed, because mortgages paid well. That's how I put food on the table, and I provided a really good living for my wife and kids, and not only just them. I was director of operations and the senior vice president at some levels of federal banks. So I was providing a living for a lot of people. So I didn't want this to be true. Yeah. But unfortunately, I followed the math and the logic that it was taught to me by a hedge fund manager of all people. And I couldn't prove it wrong. In fact, I proved him right. And, one thing he said to me that still sticks to me to this day is mortgages are financial crack to middle America. And he specified middle America. I was like, why do you say middle America? Well, the poor can't afford them and the rich don't use them. That's why it's financial crack to middle America. Poor, they're not going to afford the mortgages. They can't qualify for a mortgage. The rich, well, we don't use it. Why? Success leaves clues. They're not stupid. And when I say they're not stupid, it's not like they spend their time in books and in education in what we would consider traditional education. They just pay people for advice. That's the shortcut. That's the life hack. And it's not a secret. It's just people aren't willing to invest in themselves.
Yeah. I got to meet the owner of Paul Mitchell Hair Salon Products. Really
Hmm.
nice guy named John,
Of
billionaire.
course you did. Look at your hairline. Of course. Of course.
And I asked him, I said, you're a billionaire, a multi-billionaire. What advice would you give to me? I'm in my 30s. He said, pay off your house so that you can focus on everything else that's important. And
Hmm.
at first I didn't like that. I was like, no, that's stupid. I could borrow money for so cheap,
Hmm.
And now I have a better understanding. But okay,
Yep.
going back to mortgages, Michael.
Hmm.
Uh, this HELOC strategy that you teach and coach people from A to Z, it's not for everybody.
No.
So who is this for? That way we don't waste anybody's time.
Absolutely. And when I say it's not for everybody, in fact, it's not for most people. Unfortunately, in this country, most Americans are living paycheck to paycheck. So the number one thing you have to execute on this cash flow strategy is you have to be cash flow positive, meaning you make more money than you spend. So to a certain degree, you've already mastered your budget, right? There are some financial entertainers out there that talk about budgeting, right? So follow that. But once you graduate from being a toddler and you want to get into adulthood and take this to another level of something that's advanced, then yes, this is a good strategy for you, but you have to make more money than you spend. So you've got to be on a budget, not living paycheck to paycheck, because the only way to pay down principal is to pay down principal. Again, this is math, not magic. It's not like we're vanishing principal out of thin air. We're not, you're not coming to us and we're getting attorneys involved and we're renegotiating with the mortgage company to just get 100 grand to just evaporate. That's unfortunately not what happens. Your balance is what it is, and we show you how to utilize your cash flow more efficiently to pay down that principal. So the only way to pay down principal is to pay down principal. The only way you're going to do that is to be cash flow positive. Number two, decent credit. Doesn't have to be ideal, but it has to be decent, 660 and above, because you're going to get a home equity line of credit, a less risky one in first lien position. We do have some strategies where we teach people in second lien position as well, but there are some additional risks to being in second lien position. There's also some benefits too. Like for instance, let's say you got a mortgage last year at 2.5%. And now rates are going up. It's like, well, why do I want to give up to 2.5? Sometimes it makes sense, sometimes it doesn't, and we show you how to utilize a second lien position HELOC to do it. But again, it comes with some other inherent risk because you put the bank in second lien position, which makes them a little nervous. So when it comes time to freeze, that's the ones that makes them the most nervous. But 660 credit score and higher is what the banks like to see. And then number three is 10% equity or 10% to put down on a home. So this isn't something you already have to own a home to get into. Let's say you don't own any other home, you're about to buy a home. Is if you put 10% down, there are banks that will allow you to purchase at the closing table
Okay.
on a home equity line of credit. This does not have to be a refinance. But on a refinance, we like to see 10% equity. Yes, there are some banks out there that could go up to 95 and 100% financing, but we just don't feel like it's a good idea in this market. So we like to see folks with 10% equity or 10% to put down. So those three things: cash flow positivity, 660 credit score, 10% equity or 10% down payment.
Okay. Well, I mean, a lot of us have been blessed with equity. We didn't do anything
Oh, yeah.
for because of the pandemic and all this crazy real estate buying. That's what I did. Like I
Mhm.
hadn't paid down a bunch of principal, but my house value went up. Unbeknownst to me, no action of my own. And I'm like, babe, we got to use this blessing and use that. And now
Mhm.
we're just chopping away at that. We'll be done in less than 50 months.
Yep.
And it saved us about $250,000. Uh,
Wow.
it's crazy, like I owe you guys a dinner because it's like when I just see it, like, okay, we're taking cash flow that we already have and using it a little bit different in a product that was before the Federal Reserve like tried to own our money and our income and separate us from our freedom. And
Mhm.
now we're going back, like you say, we're going back to the basics. So I'm just so excited about this opportunity, not only for myself, but like I'm becoming like a missionary for this cause because I'm just like I want people to be rich. Like you get around some people, you tell them what you're making, and they kind of begrudge you. Like if somebody tells me how much they're making, I'm like, dude, I love it. Yes, let's go. Like,
Right.
it's so exciting. I want people in my community to have that freedom.
Think about what this country would look like. Not only now, but we could even go back to 2008. It's funny because I had a friend try to share this with me. He had a product through Countrywide Mortgage. You probably remember that name.
I had a Countrywide mortgage.
Yeah. So my sensors, hang on. If I don't move in here, this goes off. All right.
Hey, you guys are just being responsible with your energy use, right?
Yeah. No, it's if you're not in here, it just goes off, and I'm so far away from the sensor. So he worked for Countrywide, and he did a terrible job of explaining this to me. But he was like, "Look, this is what you should do." And I was like, "Man, everything I've been taught in the mortgage business, like, no, a HELOC is a credit card on your home. It's variable. I don't think I should do this." And I didn't. Lo and behold, had I done that, because what you went through, it was much worse for me. It was foreclosure, bankruptcy, cars repoed. And it wasn't for a lack of making money. I mean, me and my wife were making really good money in the mortgage business back in the day, collectively almost $500,000 a year. So we had the cash flow. We just weren't good stewards of it. It as fast as it came in, it went out. We just thought, hey, this is life, and this is how it's always going to be for us. We didn't assume or even think that the housing market was going to crash and there would be a mortgage meltdown. But he tried to explain this to me, and had I known that, I could have weathered the storm, because that storm lasted for us like maybe a year,
Yeah.
and it got back on my feet. But I could have weathered the storm. So you look at if folks, the majority of Americans were actually doing it back then, we wouldn't have had the meltdown. There
Yeah.
wouldn't have been a housing crisis, right? Now let's fast forward to today. Inflation. Yeah, we don't like inflation in any form or fashion, just like we don't like high interest rates. But our average client saves $170,000 over the course of 5 years. So that's an average of $34,000 of interest payments that otherwise would be profit to a mortgage company, right? So inflation is 8.3%, but it's not at the extent of $34,000 a year, right? So we can negate inflation by being wise Americans with our money and being good stewards, and just realizing there are alternatives. We don't have to play the same game as everybody else and be that rat on the wheel. We can take the red pill and escape the matrix and branch out, create our own economies, insulate ourselves from this economy. These are ways that you do it, among other things.
Yeah, just owning control of your freedom and then having a product that gives you that flexibility
Mm-hmm.
is incredible.
And
So,
again, in good times or bad,
yeah,
again, we're heading into a recession. If you're prepared, there's going to be massive opportunity. Always is. That's the greatest transfer of wealth is every recession. Every recession, there's someone that goes from being, a billionaire to a multi-billionaire, right? Amazon, Tesla, things of this nature. But there's people that go from a millionaire to a billionaire during recessions because they're grabbing market share. When other people are panicking, just like Warren Buffett says, be fearful when people are greedy and be greedy when people are fearful. That's what a recession is. So some folks are going to be prepared, and there's going to be massive opportunities, and they're going to expand their wealth. There are going to be other people caught with their pants down and not prepared. And right now, I think it's more about capital preservation as it is capital acceleration. So be prepared for this recession. And then when you see an opportunity, take advantage of it.
yep,
Now, unfortunately, if it hits you, just like I had probably a handful of clients during COVID where a spouse passed away or someone got sick and furloughed and had a major loss of income, well, that HELOC was their safe haven. Had it not been for that, they would have been another statistic that would have been a foreclosure and somebody on the street, where now they got their HELOC. They've been practicing the strategy for 2 or 3 years. Like, I've got access. I can weather the storm. And that's exactly what they did. It's not ideal because you'll see your balance creeping up, but it's better than foreclosure. It's better than selling the home that, has been your family home for 30 years.
yeah, absolutely, absolutely. Again, that's why I want people to get this. I want them to work with your team just like I did. I don't want to ever go through what I went through in 2008, and I don't want anyone around me to go through it if we can avoid it. Now, I know they've got to meet those 3 criteria. So if they're not there, now you got to start preparing yourself to do this. But if you're there, they need to reach out to you and they need to learn about this. So how do they do that? What is the best way for them to contact you?
Yeah, now we have done something specific to your audience, because your audience is one that we love. They're
I
good
love them
quality.
too.
Yeah, they're good quality people. We're of the same thought and mindset. So we have a special program and discount just for your audience. So you have a link that I want you to share, and want to make sure that the audience utilizes that link. Don't just go to our website. I know you see our logo in the background and whatnot. Stephen has a link that I want you guys to use, because I want to make sure you get credit for being a part of his audience.
Okay, yeah, I will make sure to leave that link down below. And thank you. I know how busy you are running a multiple companies, a family, responsible for employees, but I've had so many people already move over to you guys, and I'm grateful for that. My wife and I moved over, and so I just had to bring this information to my YouTube community. So thank you so much.
No, thank you, Stephen. Y'all take care. God bless.
Thank you. Bye bye.